Tom and Sue saved a little bit too well for retirement. In fact, they saved so well that they recently found out that the IRS was about to force them to withdraw over $180,000 a year. And that's money they didn't even need to live off of. So let me tell you a little bit more about them. They're the kind of couple that every financial advisor loves to meet. Hardworking, disciplined, lived well below their means, and they contributed to their retirement accounts every single year. But by the time they reached their early 70s, they had accumulated over $4.5 million across their 401ks and IRAs. Add in Tom's pension and both of their Social Security checks, and they were bringing in about $100,000 a year, which is pretty great. More than enough to cover their expenses, travel a little bit, and of course, enjoy the grandkids. They were living the retirement dream until one meeting with their CPA changed everything. The CPA looked at their numbers, did some number crunching, and said, Tom and Sue, you're going to have a pretty hefty required minimum distribution this year. And every single year from now, it's only going to go up and up. Tom and Sue were a little bit confused. Wait a minute, we have to take that money out even though we don't need it? And that's exactly correct. Because their retirement savings had grown in tax-deferred vehicles for many decades, the IRS was ready to collect. The money that they thought they were preserving for their future was now becoming a tax liability. And that $180,000 plus, well, it pushed them into a higher tax bracket, caused 85% of their Social Security to be taxed, and it even increased their Medicare premiums. Tom leaned back in his chair and he said, man, I thought we did everything right, but no one warned us about this part. Tom and Sue's story is a reminder that it's not just about how much you've saved, it's about how it's taxed when you finally need it, or in this case, when the IRS says you have to take it. And the truth is, tax code is constantly changing. What worked 5 years ago may not work tomorrow. And that's why today's webinar is so important, because you deserve to retire with clarity and not confusion. So we're going to talk about how to stay in tune with the recent tax law changes so that you can hopefully avoid those shocking moments just like Tom and Sue had. Now, before we dive into it, this is a quick disclaimer to let you know this is not personal information that you should take as a personal recommendation. You have to meet with a qualified financial professional, CPA, enrolled agent that can better understand your unique situation. This is purely educational and not meant to be construed as personal advice. So with that out of the way, life has a way of throwing curveballs when we least expect them. And navigating uncertainty becomes much easier when we have a solid plan in place. And today we're just going to focus on taxes. And while Benjamin Franklin famously said that nothing is certain but death and taxes, I'd have to argue that only half of that equation is truly predictable. Of course, taxes are inevitable, but how much and how will you be taxed? Well, that's where the uncertainty lives. Because tax policy shifts with every new administration and every congressional session, creating a constantly evolving landscape that demands our attention. We witnessed this firsthand with the recent passage of the Big Beautiful Bill that was signed into law on July 4th, 2025. While most provisions take effect on January 1st of 2026, well, there is impact to 2025 tax returns, demonstrating just how quickly the tax landscape can transform. While the act preserves many existing tax benefits, it also introduces substantial new tax cuts for both individuals and businesses. But here's the catch. Most individual benefits are temporary, applying only to tax years 2025 through 2028. This really is creating a planning puzzle. Will future congressional action extend these provisions beyond President Trump's current term? Well, we simply do not know, and only time will tell. These tax cuts, they do come with some consequences that extend far beyond your annual return. They're adding significantly to our national debt, and that growing burden could substantially impact your financial security in the years ahead. So today, we'll examine both the permanent changes, though remember, nothing in tax policy really stays permanent forever. And of course, we'll talk about the temporary provisions along with the true costs of those provisions. Most importantly, we're going to explore actionable strategies to help you prepare, not just for these specific changes, but for whatever tax shifts might emerge during your 20, 30, or 40 years of your retirement. The goal is not just to understand today's tax landscape, but to help build a framework that can adapt to whatever comes next. But let's start by understanding what changes based on the new legislation have taken effect. So we'll start with the permanent changes made by the new legislation, and there's no better place to begin than with the individual tax brackets. This affects pretty much everyone. The new tax law permanently extends key provisions from the 2017 Tax Cut and the Job Act that were scheduled to expire, preventing substantial tax increases for most Americans while boosting after-tax income. On the screen, you will see the 2025 tax brackets. And without this legislation, an estimated 62% of Americans would have faced higher taxes, really resulting in an overall tax burden increase of about 7.5%. Now, another permanent change is to the standard deduction. Effective this year in 2025, the standard deduction is permanently increased to $15,750 for individuals and $31,500 for married couples filing jointly, establishing new baseline amounts for taxpayers. Beginning in 2026, these amounts will be adjusted for inflation annually, providing additional tax savings for the majority of taxpayers who don't itemize. Now, for business owners, for those of you who own those businesses out there and you're listening, the qualified business income deduction that was part of the 2017 Tax Cut and Job Act, it becomes permanent, benefiting small business owners who report business income on their personal tax returns. This deduction, up to 20% of eligible revenue, applies to sole proprietors, partnerships, S-corps, and LLCs. There's also a new minimum $400 deduction that's available if you meet the qualified business income deduction requirements and have at least $1,000 in qualified business income, which basically means that even if the 20% calculation would give you under $400, you can still claim a $400 deduction. Now, for certain small businesses, those that are considered a specified service or trade business, which will typically include things like law, healthcare, consulting, or accounting, there are income thresholds at which the benefit begins to phase out, and those thresholds have been increased as part of the overall new legislation, up to $75,000 for single filers and up to $150,000 for those who file jointly. So let's consider an example here of a married couple where one spouse earns $100,000 as an employee and the second spouse earns $100,000 through a small business. And let's just assume that that small business does not qualify as one of those areas where the income thresholds apply. So this couple's combined income is $200,000. And after the $31,500 standard deduction, their adjustable gross income becomes $168,500. Then, considering the enhanced 20% QBI deduction, they can deduct an additional $20,000 from the $100,000 of business income. And this really means that the combination of these two deductions reduces their taxable income to $148,000 with $500 left over. Now, that's a great benefit for small business owners, but even if you don't own a qualifying business, this change still affects you indirectly through its impact on our national finances. See, when the government collects less tax revenue, it must either cut spending or borrow more money to maintain current services and obligations. And in this case, we're looking at a significant increase in borrowing. The Nonpartisan Committee for a Responsible Federal Budget, they estimate that just this provision of the legislation will add about $820 billion to our national deficit between now and 2034. So while you may not directly benefit from this particular business deduction, you, like all Americans, will share in the long-term consequences of the increased national debt that it does create. And a little later on, we're going to take a look at what those numbers and what it truly means. But another permanent change made by the new law locks in dramatically higher estate tax exemptions from the 2017 tax reform, rescuing it from a scheduled expiration. For 2025, individuals can shield $13.99 million from estate taxes, while married couples protect $27.98 million. These thresholds jump even higher in 2026 to $15 million for individuals and $30 million for couples, with automatic inflation adjustments continuing indefinitely. So just the $1 million exemption increase in 2026, it could save a family $400,000 in estate taxes. And that's money that stays with your beneficiaries instead of going to the government. And here are a couple additional permanent provisions in the legislation. The AMT, the alternative minimum tax, the law permanently extends the higher AMT exemption amounts and the income thresholds from the 2017 tax reform, preventing them from dropping to much lower levels after 2025 and protecting more taxpayers from the AMT liability. The charitable deduction, the new law creates a permanent charitable deduction of $1,000 for single filers and $2,000 for married couples that file jointly. That can be claimed regardless of whether the taxpayer takes the standard deduction or if they itemize. Now, let's spend some time examining the temporary tax provisions in the new law, starting with the increased deduction for seniors. So you retirees, listen up here. During his campaign, President Trump promised to fully eliminate taxes on Social Security benefits. However, as often happens when campaign promises meet legislative reality, the new law looks a lot different. So rather than completely removing taxes on Social Security benefits, the new legislation creates what's called a senior bonus deduction. Think of it as a tax break designed to help reduce but not eliminate. Okay, that's important. It helps reduce but not fully eliminate the taxes that you might owe on your Social Security income. So why didn't Congress simply eliminate Social Security taxes altogether? Well, there's three main factors. Number one, congressional budget rules made a complete tax elimination financially difficult to justify. Number two is fully eliminating Social Security taxes would have been extremely expensive for the federal government. And last but not least, lawmakers wanted to focus relief on lower and middle income seniors while avoiding additional strain on the Social Security's already pressured tax funds. So the result is what could prove for many a significant tax relief without the dramatic fiscal impact of a complete elimination. So for you as a taxpayer, this means that you'll still potentially owe some money on some tax on your Social Security benefits, but the new deduction should reduce that burden compared to past law. The new law grants seniors over 65 years of age a $6,000 bonus deduction, and each spouse can take the deduction. So that's a total of $12,000 if both of the spouses are over 65. This $6,000 per person deduction starts to phase out for single filers with a MAGI of above $75,000, no deductions if it's above $175,000, and married couples above $150,000 with no deductions above $250,000 for that couple. Importantly, this senior bonus applies whether you as a taxpayer itemize or if you take the standard deduction. And that basically makes it accessible to virtually all qualifying seniors. Now, the combined impact of the increased standard deduction and the new senior bonus It creates substantial tax savings for taxpayers age 65 and older. Single filers will benefit from an additional $7,200 in total deductions, while married couples filing jointly will receive a $14,400 increase in their combined deductions. For example, let's make this real here, okay? Let's say a married couple, both age 65, with $100,000 in income, can reduce their taxable income by just $53,300 by claiming the enhanced standard deduction, the existing deduction for those age 65 and older, and the new senior bonus deduction. So crucially, the senior bonus deduction is available regardless of whether you itemize deductions or you take the standard deduction, which really maximizes its accessibility to those who are filing their taxes. So this creates unprecedented tax saving opportunities for you baby boomers out there. So the very first thing that you want to be sure you are not, that you're doing to make sure you're not leaving money on the table is to capture every available deduction that is there for you. The second thing that you want to consider is what you'll do with those additional savings. Because remember, this increased deduction is only available for 4 years. So how are you going to make the most of those savings while you have it? That is the question. Now, if you are following any of the news as Congress was debating the One Big Beautiful Bill, you probably heard a lot about SALT. And no, of course, they were not talking about that stuff that you put on your food that makes food taste good, but certainly makes your blood pressure go up. SALT stands for state and local taxes, which include things like property taxes, state income tax, and if you live in a state with no income tax, local sales taxes. Those taxes are at least partially deductible on your federal tax return if you choose to itemize over taking the standard deduction. The current SALT deduction cap is only $10,000, but the new law increases the SALT deduction up to $40,000 in 2025, but it does phase out for taxpayers who are earning over $500,000. The cap increases 1% annually until it falls back to $10,000 in 2030. So this means that taxpayers in states with high property taxes and or high state income taxes, particularly those with incomes between $200,000 and $500,000, would see a significant reduction in their federal tax burden. And this is because they could deduct a larger portion of their state and local taxes. Now, for those who are currently employed or considering returning back to the workplace, a major new deduction available from 2025 through 2028 reduces taxes on worker tips and overtime earnings. The tip deduction allows taxpayers to deduct $25,000 up to $25,000 in tips annually, while the overtime deduction covers up to $12,500 in extra overtime pay. However, these deductions are limited to taxpayers earning $150,000 or less, with those who make more eligible for a reduced deduction. Now, if I polled everyone listening to this webinar here and I asked, to raise your hand if this new tax provision was going to have an impact on you personally, I imagine it wouldn't affect many of you. And that could be because you don't work at a job where you receive tips, or because you earn over $150,000, or maybe you're lucky enough to have already been retired. But remember that what we talked about at the beginning of this webinar here, these things, that these new tax cuts, while they're beneficial for now, they're likely to add significantly to our national debt. And that has an impact on all of us. And in just a little bit, we're going to talk more about what that might mean for your financial strategy moving forward. But first, here are a few of the other new temporary tax implications of the new legislation. The Trump account, or the kids' savings accounts. These accounts are available only for children born between January 1st and January of 2025 and January 1st of 2029. So if you're expecting a grandchild, this may be something that you may want to know about. For these accounts, contributions must be invested in a diversified index fund, and parents can contribute up to $5,000 per child per year, while the government will provide a one-time $1,000 contribution for each eligible U.S. citizen born during this period. Earnings on the account could grow tax-free, and qualified withdrawals would be taxed at a favorable long-term capital gains rate instead of ordinary income. Children cannot access these funds until age 18, at which time the account becomes a traditional IRA account. Withdrawals, though, can be made before retirement for certain expenses, for things like education, starting a business, or purchasing their first home. Another new provision is no tax on auto loan interest. So a new auto loan interest deduction from 2025 through 2028 applies exclusively to vehicles that were assembled here in the U.S. The deduction is capped at $10,000 a year and phases out at a 20% rate for single filers earning above $100,000 and married couples above $200,000. This benefit is available regardless of whether you itemize or you take the standard deduction. Now, we've talked a lot about what's permanent and we've talked about what's temporary. Now it's time to talk about the cost of all of this. As I mentioned earlier several times, while this new tax law provides immediate tax relief for many Americans, it does come at a cost. An estimated increase in the national debt measured in the trillions of dollars. The Tax Foundation projects that it will increase the deficit by about $3.8 trillion over the next 10 years. So as excited as we might be about the new tax breaks, $3.8 trillion is a sobering number. If you've ever looked at this website, it's called usdebtclock.org. And by pointing your web browser to this website, it's like you're watching your charges rack up at the gasoline pump as you fill up your car. You can really get a feel for the rapid increase in our deficits in real time. And just here on the screen, as of July 2025, the national debt was just over $37 trillion and it's rising. And when I say $37 trillion, it's kind of like saying like Ramalama Ding Dong. It doesn't really mean anything. It loses all meaning until you look at our GDP, which is currently at about $30 trillion. So it doesn't really take a rocket scientist to figure out that we owe more than we make in a single year. And that's not really a great place to be in as a country. And again, I don't think I need to tell you that our country's debt situation is very unstable. It's unsustainable. Just 6 months ago, when our debt was roughly $1 trillion less than it is today, experts are warning that it is threatening our economic future. And here's the reality. We all know that we as a country have to start paying for the spending that we've been doing. But what we don't know is how are we going to do that? And frankly, there's only a couple of options. Number one, the federal government can stop spending money. Good luck with that, right? Number two, they can reduce their future spending, so continue spending but reduce it. I don't know if that's going to happen or not. Number three, they can increase revenue through economic growth, which is always, that's the best case scenario. Or they can increase revenue with higher taxes, right? And so the government's revenue comes through the form of taxation. And so while economists and policy analysts may disagree about the political and the fiscal impacts on the economy, what we do know is that the deficit needs to be financed. And one of the easiest way that they can do that is by increasing taxes in the future. So while we have these new permanent tax rates, it's important to understand what permanent really means in Washington. These rates will remain in effect only until a future Congress or administration decides to change them. And as our national deficit continues to grow, the pressure to raise taxes becomes increasingly likely. So this potential for future tax increases should be of particular concern if you're planning for your retirement. See, many retirees depend heavily on withdrawals from accounts like IRAs, 401ks, 457s, 403bs, TSPs, and other tax-deferred investment accounts to basically fund their living expenses. And that definitely creates several areas of concern. As you can see here on your slide, every distribution is taxed at your highest rate, whatever that might be. Some distributions are required regardless of whether or not you need them. And these distributions can lead to higher tax brackets, additional tax on Social Security income, and more tax on your capital gains, anywhere between 0, 15, and 20%. And of course, the highest taxed account to leave to your beneficiaries. But here's the key point, okay? Let's wrap all this up here. every dollar you withdraw from traditional retirement accounts, that gets taxed as ordinary income at whatever the current tax rate happens to be. So while you may feel secure right now with tax rates over the next few years, your retirement is hopefully going to last a lot longer than just a few years. If tax rates increase in the future, which growing deficits make more probable, you'll probably pay those higher tax rates on your retirement withdrawals. However, there's an important distinction to understand here. Roth accounts work entirely different than those 401ks, traditional IRAs, 457s, TSPs, things like that. With Roth IRAs and Roth 401ks, you pay taxes up front when you contribute or you put money into those accounts, but your withdrawals in retirement are generally tax-free. The option of converting your regular IRAs, 401ks, TSPs into a Roth IRA means that you have the choice of when to pay your taxes. Do you want to pay them now or later? See, the main question becomes, would you rather pay taxes at today's rates, or would you rather gamble of what future rates will be in the future? Are future rates going to be higher or lower? It's anyone's guess at this point. And given the current fiscal trajectory, that's a bet worth considering very carefully. So here's a quick refresher on how our tax system works. We are a progressive system. So the more money you make, the higher tax rate on each block of higher income. Again, this means that every distribution you take from these retirement accounts will be taxed at your highest rate, okay? Let's use an example here. So let's say we have Larry, okay? Larry is single and has taxable income of $200,000. In 2025, he'll pay the rates that are shown on your screen here, assuming that there are no adjustments for deductions, credits, things like that. Note, the highest tax rate that he's paying is 32%. That's the highest bracket that he's in. But the actual tax paid at this rate is only $864. But let's say that Larry also wanted to take $10,000 from his IRA, his traditional IRA. Well, 100% of that $10,000 would be taxed at that top rate of 32%. This means that $3,200 of that withdrawal would go to pay taxes. Now consider what would happen if tax rates were to go up in the future. The higher the rates, the more of what you withdraw from this account ends up in Uncle Sam's pocket instead of your own. So considering all of that, here's the important question for you. What can you do right now to help preserve your savings and your financial future, regardless of what the future holds? Regardless of where tax rates are in the future, regardless of what political party controls the White House or Congress? Well, there are things that can be done right now to take more control of your retirement savings. And here's the shocker. You have more control than you may think over your overall tax picture and what that looks like for your retirement. You see, preserving your savings starts with understanding the difference between the micro and the macro vision of taxation. Okay, let me explain. A micro view focuses on your current taxes. Think about when you meet with your CPA. Your CPA says, what do you have to pay this year for last year's income, right? Your CPA is narrowing in and has a micro vision of what you need to pay this year, and I want to make sure that as a CPA, I want to make sure you're compliant. That's great, okay? So we're not here saying that CPAs don't do a great job, but their vision is very micro. They're focusing on this year and this year only. Whereas a macro view, and what we here at Independence Financial can help you with, focuses on lifetime taxes through retirement, which could last 20, 30, or 40 years. And our comprehensive financial planning process is designed to take your retirement, macro retirement picture for a lifetime, including your taxes, and we will bring it all into focus, okay? So we're going to talk about several big picture tax strategies that can help you take control and help preserve your retirement savings no matter what the future tax rates might look like, okay? And we'll talk about 3 actions that you can take to make the most of those strategies and to make a comprehensive financial plan, taking you to not just to retirement, but more importantly, through retirement. And do not worry, okay? These strategies are not as intense as a game of chess, which happens to be my favorite board game. Okay, as we've seen already, while taxes are generally while taxes are a certainty, there's no guarantee that tax rates will stay steady over 20, 30, or 40 years in your retirement. That's the uncertainty, is the variation in those tax rates. And those changes can have a huge impact on your bottom line over the course of your retirement. You've probably heard a lot about diversifying your investments, right? Our grandparents always told us, don't put all your eggs in one basket. But did you know that making sure you're diversified from a tax perspective, that's right, being diversified from a tax perspective can be just as important, okay? Let me explain. When we look at diversifying our assets by how they're taxed, we generally think of 3 separate buckets, okay? These represent 3 broad tax categories on how your income is taxed, okay? You have the taxable side, the tax-deferred bucket, and the income tax-free bucket, okay? And the goal is to begin moving money from left to right as you are able and if it makes sense for your tax situation in the long term, okay? So let's talk about what types of assets fit inside each of these 3 buckets. The taxable income bucket includes such things as pensions, short-term gains, stock dividends, interest on CDs, and dividends from taxable distributions from mutual funds, things like non-qualified accounts. So generally, these are accounts that are going to create a 1099 each year that you have to pay the taxes on in that year. The tax-deferred bucket right there in the middle, it's going to include things like traditional IRAs, 401ks, 403bs, 457s, TSPs, annuities, and savings bonds, okay? The income tax-free bucket includes things like Roth IRAs, municipal bonds, and life insurance if it's properly structured. So the first step is knowing where among these 3 buckets your current assets are located, okay? You got to understand where you're at. And believe it or not, the majority of Americans, they have the majority of their, guess where the majority of their investments are? They're right there in the middle in the tax-deferred bucket, okay? The next step is considering whether moving some of that money, okay, not all of it, but moving some of it from the taxable or tax-deferred bucket into the tax-free option from left to right is a possibility and would even fit your situation because everyone's situation is different, right? But how do you know, first and foremost, how do you know how diversified your assets are across these 3 buckets? Well, don't worry, we are here to help. If you'd like to receive a complimentary tax diversification review from our firm, it comes with absolutely no obligation. It's just something we think that every single retiree or someone thinking about retirement should have done. And some of you at this point are thinking, well, wait a minute, what even is a tax diversification review, right? Is this going to be dozens of pages that I can't even understand? And is it going to put me to sleep, right? The short answer is no. A tax diversification review is a simple review of your retirement portfolio to make sure that you understand how much you have in those 3 buckets so that you can see if this strategy makes sense for your unique situation, okay? What this does is it gives you a quick, glance at where you are and where you stand financially from a tax perspective and any adjustments that might make sense for your situation. So if that's something that you'd like to address, simply reach out to us by email, phone, or our website. I'll have a link in the description below. Okay, but let's talk a little bit more about one way that you can move assets from left to right. Okay, this is a very common one right now. It's something called a Roth conversion. Okay, so what this is, it's basically, for example, where we take something like a traditional IRA, okay, or a 401k, and we move it over to a tax-free asset like a Roth IRA, okay? These conversions involve paying the taxes on the money that you're converting right now, okay, rather than waiting for taxes to go up and paying for them in the future, while you're also taking advantage of tax-free growth and distributions in the future. See, because if every dollar you keep in that traditional IRA, the left bucket there, as that grows, if you keep it in that traditional IRA, it's going to grow and be tax deferred. However, if you pay the taxes now and convert it into a Roth IRA, now every dollar inside that Roth IRA is growing tax free. And choosing to reduce future tax liability by paying some taxes today at lower rates and shifting money into a tax-free account like a Roth IRA, well, it creates specific benefits that include things like tax-free distributions. If you're older than 59 and a half, you'll have immediate access to the funds tax-free with no penalties. In the case of Roth IRAs, you'll always have access to what you have converted. You do have to hold the IRA for at least 5 years to tap into the investment earnings without penalties, but still, it's definitely a perk nonetheless. Here's a huge one for those of you approaching age 73, 74, and 75. Roth IRAs do not have required minimum distributions. So you'll have the freedom of choice to choose when or even if you want to take those distributions from your account. The potential for income tax-free inheritance to your beneficiaries. Majority of the times when your beneficiaries receive Roth IRA money, it's generally tax-free. And of course, here's the biggest one in my opinion. You've basically shielded your Roth IRA against future tax law changes because you've already paid taxes on your contribution. If taxes go up later in the future, your Roth IRA isn't affected, right? And so you may be wondering whether you have any assets that could qualify for a Roth conversion, potentially saving you on future tax bills. Now, we can take a look at your full financial picture and identify potential opportunities, and there is no cost for this review. Our asset conversion review is a comprehensive review of the assets held within your retirement portfolio and their potential tax impact now and in the future, as well as a review of the potential vehicles that could create more tax efficient strategies for your retirement. So what this does is help you forecast whether your plan is as tax efficient as it could be. And what this ultimately means is that you have the information that you need to potentially move to a more tax efficient strategy, keeping more of your hard-earned money working for you instead of the IRS, right? And again, link is in the description below if you'd like to take advantage of this. There's just one more action item that we have for you today. See, we're focused during this entire webinar on reviewing new and extended tax provisions with an eye towards how those provisions, even the permanent ones, can change considerably over the course of your retirement. And the likelihood is that they most likely will, okay? And we spent time on how you can help preserve your retirement savings from these future tax changes, but this is all working toward a bigger ultimate goal, okay? And that is ensuring that you can enjoy the retirement that you've always dreamed about confidently. Whether that's spending days on the beach, traveling the US in that brand new RV, finally buying that boat, or simply spoiling those grandkids and enjoying the hobbies that you love. Developing a tax strategy to take advantage of the current and future opportunities is a critical piece of your overall retirement, but it is not the only part of your retirement strategy. See, a comprehensive retirement plan includes more than just tax planning. It involves income, investment strategies, tax-efficient strategies, healthcare, and legacy planning strategies that all work together in tandem, right? All of those areas work together to contribute to a comprehensive, balanced retirement plan that's tailored to your needs, goals, and dreams. And all are part of a written retirement income plan. Okay, and that's exactly where our firm excels. We've worked with hundreds of individuals and families just like you, whether they had a well-formed plan already or they just want some reassurance that that they are using the most tax efficient strategies for their situation, or whether they simply had, socked away money for retirement over the years, but they hadn't really before considered how to turn those retirement accounts into a fully comprehensive plan for their retirement. Just like the vehicles that we have for our loved ones, we want to make sure that they've been crash tested, and we want to make sure that they've been shown to be reliable and safe, right? Well, every person needs to crash test their portfolio and their retirement income distribution plan to help ensure that it meets the amount of risk that they're willing to take, whether that's risk in the market or that's risk of future taxes. And that crash testing is all part of our comprehensive review process, okay? Now, if you're wanting to get that sense of confidence, the place to start is with a written retirement income plan. What is a written retirement income plan, you ask? Well, a written retirement income plan is not a 45-page NASA dissertation that no one can understand. And if you have an engineer in your house, okay, listen here. I'm also not talking about that super fancy, super complicated spreadsheet that they've cooked up, okay? Now hear me out. Is that engineer in your household you? Right? I'm always happy to see that engineer has taken so much detailed time to plan ahead. And that's a great thing. They should be commended for that. But let's be honest, your spouse likely has no idea how that spreadsheet works. And what I am talking about here is a simple document that is clear and easy to understand, okay? And that document tells you simple things such as, when will those paychecks start for your retirement? Where are those paychecks going to continue to come from, right? How long are those paychecks going to last? How are they going to grow over time and keep up with inflation, right? But what all this really means to you is that you can finally stop wondering about your retirement, and now you can fully be confident and enjoy your retirement. Because with a copy of something like this, like your retirement income plan, you will literally know in advance that you have a plan in place and where your retirement is coming from here, right? My question to you is this: do you have something like this? Because if you don't, that's perfectly okay. And in our experience, it tells us that about 85% of you out there listening to this, you do not have one of these. And that's okay. It's not your fault. We find over and over again that very well-meaning advisors who've actually been pretty effective at helping you save for retirement and helping your money grow for retirement, they simply don't really have experience in helping you get through retirement. And unfortunately, retirement is 20, 30, 40 years of blissful unemployment, we hope, as long as you have that plan. And rather than our clients ever having to go back to work, we simply believe they should have a simple plan in place to continue their paychecks during what should be the best part of your life. Folks, this is one of the most frequently commented services that we provide. And while it's commonplace to us here at Independence Financial, we've come to understand that it's not common for many of you, and we are on a mission to change that. If you're sitting there right now and you do not have such a thing already created, but you would like one, simply reach out to us, okay? Wouldn't you agree that without a retirement income plan, there really is no retirement? Is it worth spending 45 minutes to an hour to chat with our advisors in person, on the phone, or over Zoom to help you understand the next 20, 30, or maybe even 40 years of your retirement? Whether it is through the phone, through Zoom, or in person, there's just three things that we want to accomplish, okay? Number one, we just want to hear your story, okay? I just want to get to know you. Our advisors want to know what's important to you and what you're excited about for retirement, because it is very exciting, okay? Number two, we want to determine if there's anything that we can do to help you, okay? Now, for about 90% of you listening to this right now, historically speaking and statistically speaking, we can help you. but that doesn't mean that we're a perfect fit for each other, okay? For about 10% of you, this is statistically what we found, for the 10% of you out there listening, we may find that you're in great shape. And if so, we'll high five you, congratulate you on the work that you've done, and we'll send you on your way. But if there are things out there that we can do to get you in a better position, we will absolutely help you set up a second visit to help better outline those things that might improve your situation, okay? And then the third and final thing is this. We just want to get a sense of whether you even want our help. Because like I said, 90% of you out there may not even want the help. You're just here for the free information, which is great, right? That's why we do this. But here's the reality. If you are seeking help out there for a comprehensive retirement plan, we want to see if you even want that, okay? Now, this visit, like I said earlier, can be an in-person visit in our office, on Zoom, or through a traditional phone call if you prefer. It's really up to you and what you prefer. Now, some of you may be sitting there thinking to yourself, well, hey, Tyler, this all sounds great, but I'm not even sure, what is the net worth of clients that you work with? Is there a minimum, right? So let me be clear about this, okay? Whether you've saved $200,000 for retirement, $1 million, or $50 million, sitting down for just 1 hour with our team can potentially help you enjoy the next 20, 30, or 40 years of your life with increased certainty and confidence. Okay, I want to leave you with this, a quote from Will Rogers. The difference between death and taxes is that death doesn't get worse every time Congress meets. But seriously, okay? We've covered a lot of information here today. We've examined how knowing the right moves can help you find the most tax-efficient strategies for your particular situation. And we want to make sure that you are well informed and armed with the information that you need to make the decisions that best fit you and your family. And if you've made it this far, we want to reward you with another free resource. This resource is completely free. No email is needed, no phone number, no name is needed. And it's basically a white paper, a condensed version of everything that we've talked about here today. And I want to make that available to you for making it this far. I'll be sure to have a link in the description below that you can download that PDF straight from your desktop, okay? And I just really hope that this can help you enjoy a long and confident retirement, right? And so I'm going to end on this note here. Feel free to reach out to us at any time by visiting our website, or you can call us to reserve that visit that we talked about a little bit earlier. And I just ask that if you did find this information helpful, please feel free to send to your family, your friends, loved ones, and coworkers. And go ahead and also subscribe while you're at it to make sure that you don't miss any future important information. I hope that you are all doing well. And as always, God bless.